Okay, so the first is I'm going to talk about just the overall financial system. You have savers and investors over here. You have people over here who are borrowing capital. It's going to be the capital markets, the stock market, the bond market, and financial institutions that are basically going to be the intermediaries between savers with surplus savings and the borrowers that have a shortage of capital or need capital. So it's going to be the financial intermediation is basically financial institutions and capital markets. And the savers are going to put money into these markets and into these institutions. Those are then going to be lent out to the borrowers. The cost of the borrowing the money is going to be higher than what's being paid the savers or the investors. So the spread between the loans and the spread between the investments, there's going to be a haircut, and the financial institution is going to take a portion of that spread between the cost, of the capital and the required rates of return of the investors. And that's basically capitalism. That's the basic system. Kind of drilling down into the accounting side, all corporations, particularly publicly traded companies, have balance sheets. You got your assets and your liabilities. You got your investments and your claims and your leverage, okay, in which the money that you're using to basically buy the assets. There's going to be short, medium, and long-term liabilities. You want to match the maturity or the duration or the economic life or the maturity of the assets and the liabilities. You do not want to mix them. You don't want mismatch. You want maturity and duration matching between your assets and your liabilities, both in the short term, medium term, and long term. So your short term assets are being financed by short term notes. Your medium term assets are being financed by medium term bonds in most cases. And then your long term assets, real estate and long lasting equipment, are going to be financed by long term bonds and owner's equity. Okay? And obviously, assets and liabilities have to match each other. This is called asset liability management. The worst case scenario is you're financing long-term assets with short-term liabilities. You're going to expose yourself to interest rate risk because the bonds are going to mature very quickly. And if interest rates rise very rapidly, and if the interest rates are the cost of your debt or your equity or your debt or short-term debt, it becomes significantly higher than the return on your assets, you could go into bankruptcy and insolvency. You've mismatched the assets and the liabilities. So the key is to match the maturity and the duration, short-term to short-term, medium-term to medium-term, long-term to long-term. Okay, if you do that, then you're very prudent in your asset liability management or your balance sheet management. The name of the game at the end of the day is really the internal rate of return or the return on your assets minus the costs of your liabilities. So if you can generate more return on your assets compared to the costs of your liabilities on the margin, you are going to generate what is called a positive spread, and you win. That's it. The wider the spread, the better. Okay? So you want to maximize the return on the assets on a risk-adjusted basis. You want to minimize the cost of the capital, or the weighted average cost of capital, to maximize the spread. This is your internal rate of return. This is your weighted average cost of capital. In a simplistic view, you would take the returns and multiply them by the value of the assets, either on a book value or on a market value basis, to get the dollar of return. You would take the weighted average cost of capital, multiply it by the dollar amount of your liabilities to get the dollar cost of the liabilities in dollars. You subtract out the dollar return from the dollar cost of the liabilities, you are going to get the dollar spread, not the percentage spread. That dollar spread is called economic value add. You want to maximize that. You want to maximize the economic value add of the company. CFOs and CEOs really focus on these things. Then if you know what the market values are, if you know what the market values of the assets and liabilities are, you can calculate the dollar returns and the dollar cost of the liabilities and market prices, not book values, and you get market value add. If these market value adds are positive over time, you win. If they're negative, you lose. That's period. That's the name of the game. And this is all done, this is basically done on the margin. Okay? So that's really the target. If you want, you can turn that off and then turn this on, and I think I can get out of here. I only got 2 minutes. I can do it in 2.